Sarah invested $100 in a Detroit rental token and woke up to find her rent checks frozen in escrow by a judge's order. Today, we unpack how tokenization's promise met legal limbo. REITs, regulated funds owning many properties, trading like stocks. You need around $1,000 to start, but you get daily liquidity and oversight. Tokens, $50 entry, direct stake in one home, peer-to-peer trading 24/7. But you shoulder custody, legal uncertainty, and often low trading volume, i.e., thin secondary markets. So what happens when the big players jump in? When institutional giants move, you know something's up. In early 2025, Dubai's DAMAC teamed with Mantra to tokenize $1 billion of real estate. Proof major developers see real upside. Fractional ownership and passive income for as little as $50. But that upside hit a hard wall in Detroit. RealT's early adopters did collect yield checks up to 12%, a dream scenario. Then, in 2025, Outlier Media and Michigan Public Radio exposed hundreds of tokenized homes with murky titles, unpaid taxes, or no legal transfer. Some tenants had no leases or utilities. Many did not even know their homes were on-chain. Repairs stalled under high maintenance costs and co-owner disputes. Imagine 300 strangers deciding on a single roof repair. Then came the shock. A Detroit judge issued a restraining order, halting rent collection and evictions on over 400 properties, citing mismanagement and safety violations. All rents now sit in escrow while the city investigates. A stark warning. Without clear rules, tokenization can amplify housing risks. And that's just one hurdle. Most tokens trade only on their own platforms. No smooth stock-style market. Want out? You may face steep discounts or no buyer at all. Exchanges like Archax and T0 are emerging, and Chainlink's network data feeds, oracles, aim to power transparent pricing, but true 24/7 liquidity stays aspirational. When homes shift to pure investments, speculation can spike prices and displace locals. A 2023 OECD report linked rising global capital to worsening affordability, and a 2024 Urban Land Institute paper warned that fractional models, without guardrails, could deepen housing gaps. And then there is the regulatory risk. In the US, most real estate tokens are securities, triggering tougher disclosures, investor accreditation checks, and tax obligations, especially if your rental payouts arrive in crypto. So before you swipe that $50, ask yourself, can I exit easily? Who's the counterparty if I sell? What if the market tanks? Am I buying real property? Or just platform promises? Tokenization makes ownership flexible, but it's not frictionless or risk-free. This was just a taste of our RealT saga. Watch the complete video for the full story, deeper data and on-chain mechanics, link below. Subscribe, hit the bell, and let me know your take.